Bitcoin has become a parallel reserve ledger recognized by Wall Street. We're not watching theory anymore, right? We're watching a transition. This is what a unit of account shift looks like from the inside. It's slow, it's uneven, and yes, it's messy, but it's happening right now. And that brings us to the real question. What do you do in a world where the measuring stick itself is breaking? How do you position, how do you plan, how do you protect yourself when the scoreboard is being rewritten in real time?
Bitcoin is not a wild trade anymore. Wall Street is now treating it as an actual reserve ledger. In 2024 and 2025, Wall Street firms like BlackRock and Fidelity have launched spot Bitcoin ETFs, opening the door for pensions, endowments, and even insurance companies to treat Bitcoin as part of their reserve. In the last year, several public companies and government entities have disclosed direct Bitcoin holdings, signaling a shift that would have sounded impossible just a few years ago. Meanwhile, the old measuring stick, fiat currency, continues to face credibility challenges as debt levels hit new highs and central banks grapple with inflation. As these changes play out, the real question is, how can an average person adapt to a world where traditional systems continue to collapse? That said, stick around until the end of this video as Mark Moss breaks down what Wall Street's adoption of Bitcoin really means for the future of money.
Hey, I am Maria with DailyDoseCrypto. Have you noticed that gold, silver, and Bitcoin have hit all-time highs recently? Is this a coincidence, or are smart investors onto something? The dollar is depreciating, inflation is eating up all of our cash, and the US national debt is through the roof, hitting new highs every day. That's why people are shifting to alternative assets like gold, silver, and Bitcoin. We at DailyDoseCrypto have partnered with ITrust Capital, your one-stop platform to buy and securely store 80+ digital assets, including Bitcoin, gold, and silver to hedge your future against debasement. With over 200,000 accounts, 15 billion in transactions, and 11,000 plus positive reviews, they're helping real investors build long-term wealth with their tax advantage, IRA, and PCA, which is a premium custody account that supports the highest level of custody and security in the space. They do this all with institutional-grade custody through partners like Fidelity Digital, Fireblocks, and Coinbase Prime, keeping your assets secure while you can trade 24/7. Fees are just 1% per transactions with no monthly or annual costs. Getting started is simple. Sign up for free and fund an IRA or PCA today. You'll receive a $100 bonus and start growing your assets the smart way. Click the link below to open your account now and begin your journey toward generational wealth.
For over 80 years, the US has issued the world's reserve currency, the dollar, right? That means everyone around the world, governments, corporations, banks, they need dollars to trade, to borrow, to save. And that privilege, it gives the US an almost unlimited credit card. Now, according to the Bureau of Economic Analysis, last year America ran a current account deficit of about $1.13 trillion, nearly 4% of GDP. That's money flowing out of the country to pay for imports, for military bases, for foreign investments, and interest on the debt. But because the world uses those dollars, they come right back in. Right? Foreigners recycle them by buying U.S. assets, by buying U.S. Treasury bonds, by stocks, by buying real estate. Now today, foreigners hold a record $9.1 trillion in treasuries. Japan alone owns more than $1.1 trillion. The U.K. recently passed China as the second largest holder. So while the U.S. runs these massive trade, these massive budget deficits, it also attracts the world's savings to fund all of it. Right? That's what we call the carry, and it shows up on the balance sheet. Now, if you add up everything the U.S. owns abroad versus what foreigners own here, the U.S. is now negative by $26 trillion. That's the net international investment position. Think about that. The world owns $26 trillion more of America than America owns of the world. And yet the system, it still runs because the rest of the world wants those dollar assets. That's the power of having the reserve currency. But now here's where the imperial part comes in. When the Fed cuts rates or launches QE, which is coming, it pumps liquidity into the markets. Asset prices rise, stocks, homes, bonds, all that creates what economists at the New York Fed call the quote, wealth effect, right? Now, they've studied this for decades. For every dollar of stock market wealth, Americans spend about $2 or 3 cents more. That extra spending boosts GDP. It makes the economy look really strong, and it attracts even more global capital that's chasing those rising nominal returns. It's basically one giant feedback loop. Policy creates asset inflation creates consumption. Consumption attracts capital, and that capital funds the next deficit. Round and round and round the flywheel goes, but every carry trade, it has a hidden risk. Because all those foreign investors, the ones that are holding US bonds and holding stocks, they're taking currency risk. If the dollar weakens or inflation runs hot, they're the ones that are going to eat the loss in real terms, right? The U.S. gets to inflate away part of its debt burden, but the foreign holders, they lose purchasing power. That's why I call it the imperial carry trade, right? It's the modern version of what every single empire does in its final phase. It uses currency privilege to siphon the world's wealth, inflate domestically, inflate asset prices, and quietly export the losses abroad. It's elegant, it's great, but it's temporary because no empire can keep this carry trade going forever. And when that carry unwinds, when the world no longer wants to hold melting dollar claims, well, the illusion starts to break. That's when the real scoreboard starts to matter. And when we switch to something else, a different scoreboard, when we measure something else other than in dollars, let's say we measure it in gold, we measure it in Bitcoin, that you'll see how far the system has already fallen. In 2020, one Bitcoin traded for about $7,000. And Bitcoin, it's been falling. It's fallen off of its high of about 126,000. Today, it's around 92,000, but it's still roughly a 13 times increase. So if we reprice the S&P 500 in Bitcoin, back then, one unit of the index was worth about 0.47 Bitcoin, but today it's about 0.07 Bitcoin. That means that's a drop in real terms of roughly 84 to 85%. Now, when we do the same for housing, a 56% move in dollars over the period, but against a 13 times Bitcoin rise, the result is a decline in Bitcoin terms in the 80 to 90% range. Even gold, which doubled in dollars terms, has lost the vast majority of its value when measured in Bitcoin. So in just 5 years, Bitcoin has completely flipped the scoreboard. In dollars, assets are booming. In gold, they're stagnant. But in Bitcoin, they're absolutely collapsing. That's what Luke Grauman calls the scarf layer. It's a living record of a dying denominator. Because what you're looking at right now isn't just a bull market. It's not just a bubble. It's the first stage of a global unit of account fracture, a slow transition away from the old measuring stick, the dollar, toward a new one. That's why the world feels so off. It's why wages don't match prices. It's why the economy looks strong on paper, but it feels weaker in reality. We're measuring our world with a broken ruler, and when you finally switch to one that doesn't change, the truth comes into focus. So now, let you understand that. The next question is why the U.S. keeps doing this, why policymakers keep inflating assets and exporting risk abroad.
The world's demand for dollars fuels a cycle that keeps American deficits running and asset prices elevated. As foreign money pours into treasuries, real estate, and stocks, U.S. policymakers benefit from easy credit and rising markets. The feedback loop looks strong until currency risk and inflation erode the gains for foreign investors. On paper, American assets appear to soar, but switching the measuring stick to gold or Bitcoin reveals just how much real value has slipped away. The official numbers hide the fact that the old financial order is already being tested by new standard. Now, let's go back to Mark Moss's discussion.
Because it's not random, right? It's a strategy. It's a play the U.S. has run before. It's what I call, again, the imperial carry trade. It's the hidden engine that's been keeping all of this alive. Every empire's currency goes through the same process. First, it dominates. Then it defends, and then finally, it dilutes. And when you reach that last stage, the smartest players, they quietly start shifting out of paper promises and into hard collateral. That's exactly what we're seeing right now. According to the World Gold Council, central banks bought over 1,000 tons of gold in both 2022 and 2023, the two biggest years on record. In 2025, they're still buying. Just in August alone, they added another 19 tons to their reserves. Now, this isn't about a profit. This is about insurance. They're swapping all those fiat IOUs for real settlement assets. Because when you trust in the unit of account that starts breaking down, gold becomes the neutral reserve choice. It's not someone else's liability. That's the entire point. Now, the dollar still dominates. It's roughly about 57% of global reserves once you adjust for exchange rates. But a decade ago, that number was close to 65%. So the change is slow, but it's persistent, right? It's a creep. While a lot of people are thinking there's a crash coming, it's crashing. Just a little bit slower than what most people expect. But at the same time, we're watching dozens of small bypasses starting to open up, right? India and the UAE, they're now testing rupee trade. Brazil and China, they've launched a $27 billion currency swap line. Iron ore contracts, they're settling in yuan. Now these things, they sound small, right? They don't look really big yet. They are, right? They're small, but they're important because they start to chip away at the monopoly of one settlement rail. That's how a unit of account fracture spreads. It's not through a single event, like most people think, but through 1,000 quiet experiments. And while governments are trying to build alternative rails, the market already has. It's already built them. Stablecoins, private dollar-denominated tokens, are now settling over $27 trillion a year. I mean, to put that into perspective, that's more than Visa. These digital dollars move peer-to-peer, across borders, without banks, without SWIFT. That's the market quietly building its own financial plumbing, one that doesn't need permission. A unit of account, agnostic system that can clear dollars today, Bitcoin tomorrow, or whatever comes next. And on the other end of the spectrum, the institutions, they've also arrived. In the first year of U.S. spot Bitcoin ETFs, we saw $38 billion in net inflows, a record for any new asset class. BlackRock's IBIT alone now holds over 800,000 Bitcoin, nearly 4% of the total supply. What this means is that what used to be considered a risk asset on the fringe is now sitting inside retirement accounts, inside corporate treasuries, sovereign balance sheets. So what does all this mean? It means the scoreboard is already changing. Even if the referees keep pretending it's the same game, central banks, they're hoarding gold, right? Trade partners are using their own currencies. Stablecoins have built a complete shadow payment network bigger than Visa. Bitcoin has become a parallel reserve ledger recognized by Wall Street. We're not watching theory anymore, right? We're watching a transition. This is what a unit of account shift looks like from the inside. It's slow, it's uneven, and yes, it's messy, but it's happening right now. And that brings us to the real question. What do you do in a world where the measuring stick itself is breaking? How do you position, how do you plan, how do you protect yourself when the scoreboard is being rewritten in real time? Well, as they say, awareness and admitting the problem is the first step. So now that you see that the scoreboard's changing, the question is, what do you do with that information? Because this isn't about trading, right? It's not about chasing headlines. It's about awareness. It's about knowing what game you're playing. It's about knowing what rules are quietly being rewritten underneath it. Now, the first step is simple, right? Measure your wealth in more than one yardstick. Now, most people only look at their net worth in dollars, right? That's mistake number one. Start tracking it in gold. Start tracking it in Bitcoin terms. Just divide your total net worth by the price of gold or by Bitcoin once a month. Now, when you do that, you'll start to see what central banks already know, that the dollar is not constant. Next, understand your positioning, all right? This isn't about financial advice. It's about building a framework that survives transitions. Every empire's currency cycle ends the same way, right? The paper gets inflated, but productive assets and scarce stores of value, they carry forward. They keep going. That's why institutional research from the World Gold Council shows gold held its purchasing power across centuries. Okay, and then comes the process, because behavior beats brilliance. Now, history shows that lump sum investors tend to outperform about 2/3 of the time, simply because markets just tend to always drift upwards. But dollar cost averaging reduces regret. It keeps you consistent and it protects you from emotion. Now, the best system is the one that you'll actually stick with.
The global currency order is changing step by step. Central banks keep adding gold as reserves, showing less trust in fiat. The dollar's share of global reserves is slipping, even as new payment rails emerge. Stable coins now settle more volume than Visa, moving money across borders without traditional bank. Institutions are holding Bitcoin on balance sheets, and ETFF inflows continue to grow. These moves signal that what once was fringe is now mainstream. And as the measuring stick changes, tracking wealth in gold and Bitcoin reveals just how much the system is already evolving. Thank you for sticking with us until the end of the video. If you found this breakdown helpful, make sure to like the video, subscribe, and check out our other uploads for more content that helps you build smarter, live better, and stay ahead. See you next time. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.